What if I told you one candle can completely change your life? You see, every candle is like a book telling a story, and there's so much information in every single candle. So much so that you can predict where price will go by simply just looking at one candle. To understand this topic further, we have to dive deeper in a term called liquidity. Now, I'm sure all of you have heard this term before. Liquidity is such a powerful topic because it's literally what makes the market move. Without liquidity, the market really wouldn't move that much.
Me? Just hanging around.
You see, these big banks and hedge funds need liquidity in order to enter their trade. Unlike you and me, these big firms are dealing with such huge amounts of money, they don't trade like a normal person. It's actually one of the few drawbacks of trading with so much money. For example, if I want to enter a position, I can really enter whenever I want. Since I'm not dealing with hundreds of millions of dollars, there will always be enough sellers to counteract my buy order. But on the other side of the rainbow, this is where big firms run into a problem. They are dealing with so much money, there are simply not enough sellers for them to enter the trade at the price they want. So what do? They create the sellers themselves. Now, big firms have multiple ways to do this. One way is they create a scary narrative. For example, Apple a couple months ago. On a mysterious night, Apple came out with a huge scary narrative that they were getting sued. Pretty scary, right? And this press release got sent out everywhere, getting a lot of eyes on it. And this news was so impactful that it dropped Apple's stock price close to 20%, leaving the market in absolute chaos. But you know what happened a month after this press release got sent out? Apple bought back $110 billion worth of stock. Just to clarify, that is the largest share buyback in US history. Now, is this a coincidence that a huge scary narrative came out right before they bought back all of this stock? Maybe, but I really doubt. Apple was wanting to buy so much of their own stock, they had to create the sellers themselves. Now, this might be a bit dramatic of an example, but you need to know how these big firms think. Another way these firms will drive down price before they enter is by hitting retail traders' stop losses. They will look at the chart, see where most traders have their stop losses, intentionally driving down the price to this area to hit all of these stop losses, which creates liquidity. Now, why am I telling you this? Because liquidity plays such an important role. And luckily for you, just like these big firms, we can take advantage of that. Here's how to do it. But first, look what I found. Have you ever heard of copy trading? Copy trading is a feature that allows you to automatically copy trades of professional traders. For example, you can go on a site called Hanker Trade, click the copy trading section, then click top performing, and you can see all of the top traders that offer copy trading on this platform. But what's really cool is you can see their win rate, how much they have profited, and also their risk factor. So maybe you want to follow somebody who has a high win rate but also has a very low risk tolerance. You can simply click this follow button and it'll automatically take all the trades this specific trader is taking for you. So you can literally copy all of their trades automatically. Pretty cool, right? If you're new to trading or even don't have the time to trade by yourself, I would definitely recommend checking it out. It's a super easy way to start growing your portfolio. If you're interested, I'll leave a link in the description so you can try out this new feature yourself. Okay, back to the video. First, go to TradingView. I'll leave a link in the description if you don't yet have it. Go to your chart and click the daily time frame. You're gonna want to find the market bias. This will usually be pretty easy to spot. For example, here the chart looks like this. You guessed it, we have a bullish bias. Here the chart looks like this. We have a bearish bias. Simple enough. It's not rocket science. That's the first step, finding the market bias. If we are overall bullish, we want to buy below the market open. If we are overall bearish, we want to sell above the market open. Here's what I mean. Make sure you're on the daily time frame. Find your bias, so here we are bullish. Then go to the latest candle and mark the open and the close of this candle. Next, go to a smaller time frame. These lines represent the open and the close on a higher time frame that we just marked. The green line is the open, the red line is the close. close. So if we are targeting liquidity, we only want to start looking for buys once price goes beneath this green line, giving us some sell side liquidity, just like this. Next, we need some sort of confirmation that price is willing to reverse from this point. An easy way to do this is to mark a break of structure. This will be the previous high before price gave us this sell side liquidity. Mark it on your chart and wait for price to come above this point. Next, we need a place to enter. My favorite way to do this is with a fair value gap. A fair value gap is a price jump that indicates an imbalance. You can mark this gap by finding the fast move, mark the candle before the move, and the candle after the move. This area is the fair value gap. Wait for price to come to this area. Enter here. Set your stop loss below this recent low and set your take profit at the market close we marked before. As you can see, it gives a great risk to reward ratio where we're only risking a little bit for a huge gain, which is exactly what we want. Wait for price to play out and boom, you got a super profitable trade. Here's a short example. First, go to the daily time frame. As you can see, we have a bearish bias. Good. Mark the open and the close of the latest candle. Go to a smaller time frame. The green line is the open, the red line is the close. Since it's a red candle and we're shorting, it's reversed. Wait for price to break the market open. Next, mark our break of structure, which is the latest low. Then wait for price to break this break of structure to show it's changing momentum. Mark down your fair value gap, wait for price to come to this fair value gap, enter your short trade here. Set your stop loss above the market open, set your take profit at the market close. And just like that, you got another winning trade. Try this strategy out yourself and let me know how it worked for you on Instagram. I would love to hear you guys' progress. Thanks for watching and I'll see you guys next time.